There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome. Technical delays. Today is the 21st of December. This is the midweek software strategy session. I am your AP risk manager. My name is Steve Vetterl. We're going to go through a quick spin. I would highly encourage everybody to watch my Saturday recording where I did a real deep dive on this. I also went through a complete soup to nuts of my equity process as an advisor for clients. So let's get into the calendar. Do note, as I'd mentioned on our AP social platform, I will not be broadcasting, nor will there be a recording on Saturday. We're going to actually be out of the town in the mountains, so we won't have any Wi-Fi access. Plus, it's Christmas Day, so Merry Christmas in advance. Let's take a look first at the futures charts. We're going to rip through this real quick. Some of you may have seen this before. This is finviz.com. Always search on daily, in my opinion, search by futures, and then click on charts. And what this does is this allows us to have a really good visual representation, just from a broad macro standpoint, of the comparisons between the different markets. So we have, obviously, the end of the world yesterday, and apparently a recuperation and now love again for equities. So these COVID variants have had varying degrees of impact on the markets. In addition to the main five that I follow, being Dow, S&P, and a little bit less on the Dow, but certainly S&P, NASDAQ, small cap Russell, this is a big area, and then all of the DAX and Euro Stoxx 50 indexes. As you can see, everything looks similar, right? So there's a lot of commonality among these charts. They are very correlated in movements as far as equities, right? VIX has had some periods of time where it spiked. Now it's back down. Notice the crude space has continued its drag down to lower levels. A lot of this obviously due to COVID lockdowns in certain countries. No surprise, we've had reactions, albeit the biggest surprise in this whole thing as far as the metal space is the lack of participation in gold. I don't know if this is sort of our canary in the coal mine right now, but typically you'll see a flock to metals, a flock to the credit markets, being bonds, when, especially in the gold area, when you have disruptions or concerns globally, right? It's almost like a flock out of equities and commodities, generally into a fixed space or a 2-year treasury space, which is some of the most secure as far as large investment movement. But outside of that, I'm not going to go through this too much. I always try to look for outliers, what's doing well while what's selling off, right? Some are due to supply chain issues, which certainly is the case with corn. Some are due to really just a drop in use as far as commodities. This is the one I'm paying particular attention to, only because we're looking to build a house in Florida. So looking in the bond space, which does affect the dollar, which in turn affects almost every other currency out there. So you got to be on alert for these different things. Note that the dollar, from the rip that we've been talking to, this particular movement, right where this just took off. I know this is not the easiest to see, something a little larger, but this was the sort of line of demarcation, if you will, at the 94.50. So as we came up, I talked very, very heavily about this, and we had almost like a cup with handle type of chart setup. So when we broke above this level, I just basically said I would not be short the dollar in any form. And how that ever converts into any of the other major currencies, I just would not be betting against the rise of the dollar while it continued to rip for close to $2.50. So the rip's over. Now we're finding a new upper zone of balance area, which I'll go into more. But just a overview, you can look to see, obviously, if the dollar is rising, all these other charts look like the opposite, right? Of note has been the weakness in CAD. So you can see in terms of at least the daily chart patterns we're looking, this is a fresh new low. And that's of note. So GBP CAD, they've both been weak. This is the neo currency pair, right? They've both been weak over the course of just the last, hell, since the beginning of the fourth quarter. And I'll move up to, because I think it's easier to do a little analysis on larger, see if I can make this screen a little bit bigger. And then I want to see weekly charts. Okay, so, in terms of CAD, I mean, we're absolutely there. I mean, this is, in terms of, 2 years, we're at the edge of the cliff. We're on it. Argument certainly can be from a pound perspective. Weekly chart, again, we're looking at each candle represents a single week. We're at the edge of the cliff. I just really, if these to continue to drift lower, I wouldn't bet against them on whatever the opposite side currency is in either majors, minors, or cross type pairs. Now, let's see, what else can I glean from these charts? Note the price declines in the short end of the credit markets, not as much in the long end, right? So this is that flattening of the yield curve that you're seeing, which just means banks, and a lot of this has to do with, obviously, the Fed purchases, which, assuming is going to be tapering significantly, will take some part into that. So if we get out of that, we're into the Forex factory. This is this week, just in case, because I get this question a lot, how do I get rid of these? You just go in and filter them out. I only care about the red folders. Obviously, it's a weekly holiday. It's not going to be much going on. Friday is a bank holiday. Why? Because it typically will celebrate the 25th on an actual weekday, as being the 24th, in some cases Monday, if Christmas falls on a weekend. So just note that. Nothing really going on the holiday, both Thursday and Friday, as far as the Eurozone, in my opinion. Volumes are lower. I haven't been trading, which I've announced in the AP for almost the last 2 weeks. We're actually packing up and getting the team started in Florida with first down, so I just haven't had the inkling to chase the markets around. So S&P, start off with the charts. Just going to go through these real quick. Still inside the zone. Notice we've bounced off of probably our first touch of this big 200-day moving average, or I'm sorry, 100-day moving average, the yellow line here. That was fairly significant. Notice last time we hit it, we bounced, hit it again. This was earlier yesterday. We've bounced off it significantly, and now the shorts are on the run. How does that typically affect the DXY? And obviously we've got big ups in the markets where we had big downs yesterday. So it's like the world's ending yesterday, and now the world's great again. So you can never know what's going on with equities. But this is part of the problem with why I don't like trading during holiday times. If you're in trading the minutia of some smaller time frame chart, like a 5-minute or a 1 hour or 30-minute, which is a typical market profile chart, you're just mired in issues, right? So skipping past that, let's go in and take a look at the dollar. Do note the European equity markets are up as well, and they are now closed. So, dollar, just a bigger graphical representation of what I was saying. I expect us to continue, at least for the next 2 weeks, possibly the next 9 days. Some business days in there, obviously the holiday, New Year's, and I don't expect things really to get totally crazy if you're looking at the calendar here till about, I should say, settled out and folks back to work around the 4th. That in mind. Euro US dollar, opposite sides of the equation from this. We're looking, let me just drag this up. Looking at edge of the cliff. I don't really expect it to break under this. I would expect this to continue to trend and build a sideways pattern. Balance area, if you will, somewhere just under one spot 1350-ish bottom sort of cliff edge on this chart daily is right around one, almost the century mark there, one spot 12. $1.12. Same thing to be said. British pound, 1.3170-ish area is the bottom. This could actually break lower, just based upon what the dollar's doing. Seems to be its own beast and continuing to grind lower, even though the DXY hasn't broken out higher. Of note is certainly this CAD movement. Let's move back to daily chart. Dollar obviously surprised against that. USD JPY stuck in a balance area. Long balance area on Swiss dollar relationship. Euro GBP still stuck in the balance area. Let's take a look at GBP CAD. Now, of note here that I did want to point out, as I said, look out for any strength in the British market in relation to Canada because of the weakness in the Canadian currencies in relation to most, including this particular pair, which is the NEO pair. We're up against a lot of stuff here. So even though it looks like, hey, we're breaking out, I mean, it is the holidays. Typically volumes are lower, as you can see here on the chart. Do you trust these types of breakout moves? Typically, I don't. Unless, of course, this puts in a weekly candle above this level. And then it absolutely argues for us to get back into this upper zone. But I think they could completely halt this. And the problem with a lot of the variables that go into this type of prognostication is I could be totally wrong in that, we could just be balancing between, the higher levels of this particular zone all the way back down to the lower part. Obviously this is predicated upon significant strength coming into Canada's currency, which I just don't see happening at this point. Countries that are always the biggest risk for lockdowns are more socialistic based systems like we're seeing in Australia and Canada. They are more susceptible to wrecking their economies with continued lockdowns. Just keep that in mind as you're looking at these charts. Take a look at gold. Of note, a lot of people can't understand why we're not rallying in gold. There's just basically the answer is there's sellers up here, institutional sellers. It's that simple. Take a look at this. We auctioned back up into this area on this daily chart. This is the Spiders GLD, which is a good representation from a volume perspective of a super liquid ETF. So as you can see on this particular day, we gapped down, we had high volume. We almost 13 million shares traded. Very, very active ETF, so it's easy to measure. And in many cases, it's easier to measure a bunch of things, mostly being volume, than it is just the spot market for gold dollar, right? Lots of things you can look at on this chart, but when it comes to the real active ETF that represents, or at least is a super solid representation of that particular sector, you can do an equal amount, if not better, in terms of analysis. You can put market profile charts on, as you see here on the left, or recognizing volume, which is this essentially is an aggregate of. And if we're over the whole period of time that we've spent in this gold chart, the aggregated volume is all executed right around this, this whole 1670-ish an ounce area. Quick look at oil coming back from Armageddon yesterday. Quick look at crypto bouncing back. A lot of people thought this was a big area of support. Problem with any of these charts is low liquidity and or not trusted data from exchanges and shenanigans going on in crypto brokerage land. Really makes this a treacherous type of coin to predict any kind of movements from. But just looking at it from a pure technical analysis, as all other factors are equal, this really is a pretty decent support level. I'd be much more interested in being a buyer of this currency around 20K, which I've been talking about for months now. May or may not ever show up. Could be wrong, right? Whole bunch of factors, including social media, that can completely influence this. So everything I may be giving you has been pretty spot on as far as technical analysis, but at least from here to here, I was pretty solid. But all these movements have been okay, but there's been just a whole host of risks that can screw this discussion up. So I just bring my chat about this, just understanding generally what's going on, and the big caveat that I could be wrong. So essentially that is the quick and dirty presentation today. But if you want the deeper dive, listen to Saturday. I will not see any of you until a week from today. So wish everybody a Merry Christmas.